The candlestick charts on a standard retail brokerage app represent a fraction of the actual market. This public data is a delayed reflection of high-level institutional activity, providing a narrow view of true price movement. These public exchanges, like the NYSE and NASDAQ, form the lit market. In this environment, every bid and offer is visible, creating a public stage designed specifically for retail participants to interact with one another. Because retail traders rely on these lagging, public-facing indicators, institutions categorize their trades as uninformed flow. This group lacks the millisecond execution speeds and the internal order book data that professional desks use to find an edge. High-frequency algorithms actively exploit this predictability. They identify where retail stop losses are clustered, drive the price to trigger those levels, and absorb the resulting shares at a discount before the market reverses. This raises a critical question about volume. If the massive, market-moving block trades aren't showing up on these public lit market charts, where is that capital actually moving? For the average trader, the public market is an extraction point. They aren't just participating in a system, they are providing the liquidity that institutional algorithms need to function. Historically, stock exchanges were non-profit entities. All orders were kept in a strictly private order book, ensuring that a trader's intent to buy or sell a large position remained hidden from competitors. The turning point came with demutualization. Exchanges transitioned into for-profit corporations and realized their most valuable asset wasn't the trade itself, but the data inside the order book. High-frequency trading firms purchased this data to see institutional orders before they reached the exchange, stepping in front to buy cheaper and sell back for a profit. As exchanges monetized transparency, large-scale buying programs were picked apart by predatory algorithms before executing. Modernization transformed public order flow into a commercial product, forcing the world's largest funds to seek a secondary, private environment to conduct their business. These private environments are called dark pools. They are matching engines owned by major banks, where institutions can swap massive blocks of shares without listing their intent on the public NYSE or NASDAQ order books. When a hedge fund buys millions of shares inside a dark pool, the public lit price does not move. The fund can finish its entire position in secret, preventing the price from skyrocketing until the trade is already complete. Retail traders are funneled into the system through their brokers. Instead of sending your order to the public exchange, brokers route uninformed retail flow directly into these private institutional pools. Dark pools rely on this retail liquidity. Institutions use these smaller, predictable retail orders to fill the other side of their massive block trades, allowing them to build positions silently without alerting the wider market. Wall Street uses the dark to absorb retail panic and finalize their own entries, only allowing the public lit market to see the move once the institutional position is locked in. Navigating this environment requires abandoning the public indicators provided by brokers. The solo quant approach shifts the focus away from charts and toward the raw data streams used by the institutions themselves. Order flow tools like Bookmap and footprint charts allow traders to analyze the math inside a single candlestick. This reveals the specific volume of buyers and sellers at every price point in real time. Even when trades are routed through dark pools, the final execution leaves a mathematical footprint on the tape. By tracking these footprints, it becomes possible to see where large capital is actually being deployed. An abnormal cluster of red negative numbers on a delta footprint chart reveals a surge in retail selling. This signals absorption. Despite panic, the price holds. A hidden institution absorbs the orders. Once accumulated, the market rapidly reverses, trapping sellers to fuel an upward move. Successful execution depends on ignoring market predictions and instead identifying these massive, passive institutional limit orders that are holding price levels. By identifying these hidden executions, independent traders move away from retail speculation and align their trades with the actual volume moving the market.